Today we are analyzing the case of Reliance Capital, focusing on its group level defaults and insolvency and what this means for fixed income investors in India.
Imagine investing in a AAA rated Indian financial group only to see it collapse into insolvency within a few years. That's exactly what happened with Reliance Capital. Today we analyze Reliance Capital's group defaults, its resolution under IBC, and what this means for a fixed income investor in India.
Now I'll talk about timeline and why it matters. Reliance Capital is a part of the Anil Ambani-led Reliance Group. Between 2018 and 2020, multiple group entities defaulted due to high leverage, weak cash flow, and governance concern. In November 2021, RBI superseded the board, and in December 2021, Reliance Capital was admitted to insolvency under the IBC. For investors, this case matters because it exposes hidden group risk in Indian fixed income market.
So, what was the issue of group defaults? The core issue wasn't just one company failing, it was group level financial contagion. Reliance Capital had exposure to stressed subsidiaries in housing finance, commercial finance, and infrastructure lending. As a group entities defaulted, investor confidence collapsed, credit ratings were repeatedly downgraded, and refinancing became impossible. This shows that group structure and intercompany exposure can magnify default risk, especially in NBFCs.
So talking about first concept, credit risk and probability of default. From a fixed income perspective, this is a classic example of credit risk and probability of default case. Despite investment grade rating earlier, Reliance Capital's actual PD increased sharply due to high leverage, weak asset quality, group guarantee and cross exposure. Rating agencies reacted late, highlighting rating lag risk for bond investors.
Now I will talk about duration risk and price impact. So when credit risk rises, bond yield spike and price falls. Longer maturity bonds of Reliance Capital suffered of higher price erosion due to duration risk. Investor holding long duration debt instruments based disproportionately higher losses, providing the duration amplifies and credit shocks.
As we show some simple timeline chart on our screen, first is credit rating downgrades, second is default across group entities, third is RBI intervention, fourth is IBC admission and final resolution. So this visual clearly connects governance failure that leads to defaults, and default leads to investor losses.
And now let's talk about resolution outcome under IBC. In 2023, Reliance Capital was acquired by International Holding Limited, with the leaders recovering around 9,500 crores. While this recovery was better than liquidation, bond investors still faced haircut, especially unsecured creditors. IBC worked, but value arose before resolution was significant.
This image shows the basic rule of investing. Higher returns usually come with higher risk. High yield bonds may look attractive, but they often hide credit and governance risk. When investors chase yield without understanding group exposure, they risk losing their capital.
Our final recommendation to a fixed income investor is simple. Don't rely only on rating. Analyze group structure, cash flow sustainability, and duration exposure. The Reliance Capital case reminds us that in Indian fixed income, risk is often invisible until it's too late.
The Reliance Capital case clearly reminds investors that understanding risk is more important than chasing returns. Thank you.